Recalling the emotional roller coaster of 2023 stock market? Want perspective on key events that impacted your portfolio? Before looking ahead, we're recapping the past year's twists and turns. Let's get some perspective. Welcome to another episode of Christian Financial Perspectives. We're so glad that you've joined us. My name is Shawn Peters, for those who haven't joined us before, and I'm joined by my co-host and father-in-law, Bob Barber. Today, we are bringing you our 2023 financial recap, and this is released right after Christmas, but we did, because of the magic of Hollywood recording, or whatever you want to call it, we, believe it or not, did have to record this a little before we published it. So if anything has come out since right before Christmas or after that we don't have on here, we apologize. Well, maybe we can try to put something in the description, but yeah, what a year. I mean, we have grown a lot, I feel like, Bob, as a show. And
we have.
I mean, we have for those who don't know,
80 episodes now. We started off as a podcast the first 3 years.
And this should be episode 188.
Is that what it is? Okay.
Yep. So we'll hit our 200th one come 2024. And
exciting.
Just a quick shout out for those who don't know, my wife took over editing, not sure how many episodes exactly back, but Bob's oldest daughter. And thank you, Jenna. I think she's done an awesome job. Hopefully you guys have appreciated some of the, graphics and transitions, and, it's made a difference.
She makes you and I sound good. I know that.
Which is a task.
If we stumble, by the way, she takes the stumbling out.
Exactly. Well, as much as she can.
Yeah.
Yeah.
All right. So let's get to the financial recap.
That's right.
We do thank you very much, Jenna, for the incredible job that you do. Of course, you're extremely smart, and you go beyond anything that your dad has ever done, I think. So, it was quite a year, Shawn. As we look back and do a financial recap of 2023, we had a market totally consumed with interest rates. I mean, you couldn't turn on the financial news daily without nearly every interview
something related
to do with interest rates and how they were going to be affected by, consumer news. Yeah. And then we ended up having a very, very narrow stock market that we're going to go into a little bit here for much of the year, based on what they call the Magnificent Seven.
Yeah. I like how you said that, Bob, for anyone watching that may not have seen one of these, but we do a monthly bullet point kind of it's meant to be a 2 to 3 minute little recap of what was going on. And Bob called the S&P 500 the S&P 7. Yeah. Because that's basically the tail wagging the dog. Is those seven?
That's what it was for the first 10 months, but it's spreading out. And then we had some of those bank failures earlier in the year. So let's get to it. The market consumed with interest rates. You could not turn on the daily news without the concerns about the Federal Reserve and what they were going to do based on employment, unemployment data, inflation, retail sales. And it just caused extreme volatility throughout the year.
That's right. And the Fed increased interest rates by 0.25% increments in February, March, May, and July.
And that was the last one in July. They're not going to have any more interest rate increases by the latest news that we have. Yep. The 10-year Treasury bond was a really big newsmaker. And the 10-year Treasury bond, the reason that's so important is that's based on a lot on how mortgage rates play into the equation. Yep. And in July, it was a little bit under 4%, but then it rose to nearly 5%. Yeah. It actually touched 5%. It kind of kept
touched, and it was flirting with 5% for a while.
One day, it went over 5% for just 10 minutes. But then, as we speak to you right now,
and that was the peak, like mid-October.
Yeah. And as we speak to you today, as of December 14th, 15th. The 10-year bond has gone back below 4%. I mean, this is just really fresh news as we bring the podcast to you today. So it's really been interesting to watch these rates pop around. You could see as the 10-year bond rate went up, the markets went down, vice versa. Yep. So it's ended up being this year-end rally, and I was predicting this year-end rally. Our clients kept calling. I said, we're going to have a year-end rally. I see it. It's written all over And it's just in the handwriting nearly.
Just a lot of factors.
Right. But you've been whipsawed around a lot this year, and it just proves you've had to have a long-term perspective and not let your emotions get involved in investing.
Right.
Okay?
That's right. As Bob mentioned earlier, it was also a very extremely narrow market for stock returns for the first 10 months of the year.
Yeah. Right. And that was based on basically the 7 companies, which these are woke companies, so we don't invest in them. They're not biblically responsible, but it was Apple and Google, Microsoft, Meta, which is Facebook, Tesla, NVIDIA, not the other 493 companies of the S&P 500. It's like these 7 just went off and left the other 493 in the dust. But the way that it's reported in the news, it's reported always is the cap weighted, not the equally weighted
That's right.
S&P 500. So if you were to look at the equally weighted S&P 500, which is a better way of looking at the Fortune 500, you'll see the difference in how they just pulled apart. And a lot of that had to do with AI. Coming out, artificial intelligence made a huge splash.
Even though there's been a lot going on in that space, it seems like 2023 was kind of the year of AI, with just so many different areas that it was affecting. And of course, there's also a lot of speculation on, it's going to do this or that. And, there are many things I've heard. I'm not going to go into any details, but there's some stuff that you see it come across. And okay, realistically, that's probably more like a 10-year thing, but people are acting as if it's happening in 2024.
There was so much emphasis put on NVIDIA because NVIDIA came out with some very good news, and NVIDIA went up to over 240% at one point.
And if I remember correctly, Bob, that was partially to do with the way, for those who haven't looked into it as much, but believe it or not, AI does require a lot of computing power.
Yeah.
But it's a little bit different in the way that it works. And so NVIDIA, a big part of their increase had to do with them getting involved and starting to be used more, I think, on the GPU side of things for the AI. Yeah, that was interesting to see. This company going up this much kind of reminds you of the 1999 internet bubble.
Yes.
A little bit.
So fast, so quick. The PE ratios just got way out of whack.
Yeah.
Way far away from, the overall average PE of the market. And will it be able to catch it? Thinking that these are the only guys in town. And now the news is coming out more and more that it's not. I just heard another company, a big company. I'm not going to mention the name because that'd be like saying a stock tip, okay? Yeah. But this morning, how all their computers are going to be built with the AI chips, and they're not getting them from NVIDIA,
which dropped NVIDIA down about 20% from their earlier highs.
As of when we're recording. And it's not just that news, but it was just got a little, as I say, frothy. So the last several months of the year, it's been interesting to watch the market returns finally spreading out to the other 493 companies. Okay.
Yeah, exactly.
But in the beginning of the year, also we had these large bank failures. We had a
back
few
in the spring.
Of them back in the spring, and this caused widespread fear that other banks are going to collapse. We saw the entire banking sector just being sold off.
Yeah,
ridiculously dropping by 28 and 30% in value, creating some really good buys.
Yep,
by the way,
that's right.
And it was basically the 2 large banks were the Silicon Valley Bank. We heard that in the news back then, and Signature Bank. And they were the 3rd and 4th largest bank failures in the United States since 2001 in total assets lost. So that was a big deal, but we seem to have gotten past that now, and I'm glad that we have.
Well, because remember, the banking system works as long as we all think it works.
Yeah.
Which, I mean, it kind of is about that simple.
Yeah, that's right. So the last part of, as we recap 2024, was there just seemed to be a constant fear of recession. And it wasn't, not 2023, going into 2024.
Yeah.
For 2023, there was a constant fear of recession. By the way, this has been going on now for about 18 months. It's just recession is going to happen. And it never did. The unemployment rate never went above 4% for the whole year of 2023.
Which is phenomenal.
And the CPI, inflation, Consumer Price Index, it started off at 6% at the beginning of the year, and now it's half that.
Yep, 3.1.
Yeah, so that's right at half that. We were pointing this out the other day. We saw GDP numbers come out.
Yeah.
which were double what they were a year earlier. So
yeah. Came in at 5.2% compared to 2.7% a year before, the year earlier.
Yeah.
Yeah. Which is phenomenal. I mean, anytime our GDP is 5% or higher, that's a good rate. So, and what was the analysts originally? I think they thought it was going to be 4.9, I think, or 4.8. And then the initial results came out at 5, but then when they finalized the results, it came out at 5.2. So, I mean, it's been good.
So the economy has been operating on all 8 cylinders. If it was an 8-cylinder car,
I think it was the third quarter earnings came out, and for the S&P 500 companies, over 80% of the companies beat
the
analyst
estimates.
Earnings.
They sure did. That's right. The supply of goods was nice too. This last year, it seemed like the supply caught up with the demand.
That's right.
And now, when I drive by the car dealerships now, I see so many cars. Where I remember, at, the beginning of 23 and at the end of 22, the lots, they were empty.
Yeah.
But now there is plenty of supply, even maybe a little bit too much supply, which is helping to pull down inflation.
Exactly.
All right. That's a recap of 2023. Looking ahead in 2024, first of all, it's a presidential election year.
Yep.
Okay? Need we say more? The party in power usually wants to do everything that it can, that's possible, to make that economy look really good so they can get back in power.
Yep.
Yeah. In the election.
Which, I know they're going to do that.
Yeah.
I'm just hoping that maybe we won't get as much printing money and passing out stimulus checks and all these other things make people feel good.
Yeah.
Because
don't buy the votes. Please don't buy the votes. Come on.
They do that and don't be fooled by that. They send out these checks and you think, oh sweet, I got an extra $1,000 or $600 a person or whatever it is. But it's just going to make it worse.
Right.
3-4 months later, now inflation's worse.
Yeah.
It's the worst thing they could do.
Yeah.
Oh, anyway,
I'm worried a little bit that the Federal Reserve just said, yesterday as we make the program again, that maybe we're going to lower rates 3 times next year. Mm-hmm. Well, hopefully that's not going to be a political thing and it's going to turn that way. But because that could be a concern. The markets love it when interest rates go down. Yeah. And so if they start lowering those rates, but they need to be careful because they over tightened. Yeah. And now they need to be careful of loosening up too much.
If anything, Bob, they should have just said, we're not planning on making any rate changes next year. Just leave it alone for a while.
Yeah.
Because it's like they keep acting like they're driving a speedboat instead of a huge tanker.
Well, that's one of the things that's pushed the market up so quick, though, too. Yeah. Now,
just the announcement that they're going to drop rates.
Because, they're thinking it's going to happen around March or April is what the market's thinking. And maybe another one by the summertime. You know what? We'll just wait and see.
Yeah,
we'll see. Bottom line. I think returns in 2024 are going to continue to spread out. Yeah. Also, just from the Magnificent Seven, as we call it, or the S&P 7. That's what the CNBC and some of they called it the Magnificent Seven. But everybody's talking about that now because so much money went just into that piece of the market. It needs to spread back out, and that's what's happening right now.
Which is good. It's better in the long run.
And I think we're going to see short-term CD rates for banks. That's going to be going down this next year. Of course, when rates go down, boy, it was nice while it lasted. It lasted about a year and a half. That above 5.5. I looked this morning. You can still get a 5.5% rate if you can get it. Go for it.
Yeah, because if you can find one for a 12-month,
take it.
If you can find one for a 20,
if you can find one for a 24-month, definitely take it. I saw some 3-year CDs this morning at like 4.9. I may even take that. Yeah, because it's so close to 5%. So there you go. That's a lot of information. I hope that was a good recap for you. We hope you have a very happy new year. We're looking forward to the year coming up. And anything else?
As always, thanks for joining us. And if you have any specific topics you'd love to see us cover or possibly discuss on an episode, pop that in the comments, or you can visit our website, christianfinancialadvisors.com, or you can call or text us, 830-609-6986.
We got some great topics coming up in the next 2 or 3 weeks, so stay tuned because we've already made some of those programs, and they're very good for the time period.
Well, we're always open to suggestions.
Yes, absolutely.
So thank you as always, and God bless. Thank you for watching. If you want to see more videos just like this, make sure to subscribe, turn on notifications, and like this video. If you have questions, you can visit our website, call, text us, or comment below. See you next time.